Okay, the Lyft IPO. Let's be honest, it's one of the most talked about things on the stock market over the past couple of weeks. I have refrained from talking about it since it IPO'd at the end of March. And, I want to tell you why I'm staying away from this IPO, even though I do like Lyft as a company. So I'm going to start with talking with some of the positives of Lyft stock. But as we go along, I'll show you the negatives, which is why I will not buy Lyft stock. And let's just get straight into it, shall we? So Lyft, the company, I'm sure most of you probably know what they do because you've used their service before. And generally, I do actually recommend those as the stocks to look at, the ones in which you know, the ones in which you've used their service, you can understand the company easily. Lyft, it's a very easy company to understand. Lyft, they are obviously what would you call them? The transportation company, the ride sharing company. Anyway, you know what they do already. They give rides to people. It's kind of like a taxi company, but a whole lot cheaper and also a lot more effective. The Lyft model of doing business is so much more effective than a taxi company. Okay, anyway, Lyft is one of the biggest transportation network companies in the world, but obviously they operate only in the USA and Canada, in approximately 300 cities with over 1 million rides per day. They have just over 30% of the market share in transportation network companies in the US, and Uber has pretty much the rest of the market share. Okay, and I believe the reason for investing in Lyft, is pretty obvious. This is what the bullish investors would say. Lyft is in an industry of transportation network companies that is changing the way people get from place to place. Taxis are becoming less and less relevant, let's be honest. So, they're in this high growth industry, and they're also a high growth company, as you'll see later on in the video. The revenues are growing at astounding rates. And bull investors would say, as time goes on, surely they're going to be able to keep growing and growing in this high growth industry and essentially make a lot of money. First of all, yes, they could be right. That's definitely a possibility. Still, it does not mean the stock is definitely a buy. Keep watching, I'll show you why. Okay, the first thing that we have to remember about the Lyft and Uber battle is that Uber dominate the rest of the world, whereas Lyft competes with Uber in the United States. And I gotta be honest with you, they are doing a pretty good job of competing. If we take a look at this graph, we can see that they have been eating into Uber's market share for a good period of time now. If we look at the 2015 figures, Lyft had just 9% of the US market share. Then I just want to go along for a bit. And at the end of 2018, they had 28.4% of the market share. So what's that? From 9% to 28.4% in just a couple of years. Now they have 32% of the market share at the time of making this video. So the pattern is in Lyft's favor. Uber has had a lot of scandals, and I would say that people see Lyft as the more ethical way of traveling. And I would also say that Lyft give a better service than Uber at a price that is pretty similar. Okay, so the graph is obviously in Lyft's favor, but the thing that we have to realize about both of these companies is that they don't have much of what Warren Buffett would say is a moat. They don't have something that is really gonna make it hard for competitors to come in and compete with these two companies. So yes, they'll obviously offer the app on the phone, but how hard is it really to build an application? Especially if you're a company and you can hire some developers to build one. It's not too hard to build an application. I mean, it's not like they're building a fully electric vehicle or a smartphone. No, it's just an application. But the one advantage that I would say that Lyft and Uber do have is the fact that people know about the application, have downloaded it, and have used it. It's something called the network effect. Okay, so that's one of the advantages. But still, guys, it is very doable to market your app well, pay for some Facebook ads, and then network effect and get people knowing about your app. So it's a competitive advantage, but it's one that certainly can get eaten into over time. So what I'm saying, guys, is that it's not too hard for a competitor to come in and compete with Uber and Lyft. They just don't have that sense of protection which a lot of tech companies have. Now, why is this a problem? Well, if more competitors come in and compete, what's that going to do to both Uber and Lyft's market share? Well, it's going to decrease, of course. Then what's that going to do with the way that they can price their rides? It's just supply and demand. Increased supply means prices will become more competitive and thus go down. Then how will this affect their profit margins? Not the best. So even though that the ride sharing market as a whole is increasing and the pie is getting bigger, guess what? There will be more companies fighting to get a bite of that pie, which will make it harder in the long term for Uber and Lyft to maintain their market share of a growing market. Now, we all know that Lyft's IPO is priced to grow, and not just grow, but grow at massive rates in terms of revenue and profitability. Can they do this? The answer is yes, they can, but probably not at the rate that most investors would want in order to justify Lyft's current price. Let's go to the income statement. Okay, so straight away, when you look at the top line growth, you can see why some people have valued this company quite highly. I mean, their revenue has grown from 343 million to 2.1 billion in just 2 years. Now, one of the things that I like to look at with these types of companies is their price to sales ratio, or price to total revenue ratio. So total revenue is 2.1 billion and Lyft's market cap is 20.1 billion. So at the moment, the price to total sales is about 10, which is way too high for me. Maximum I would like to pay is 5 or 6 for this company. Generally, I like a price to earnings of 10, not a price to sales. I mean, if you go and look at pretty much all other tech stocks, they're nowhere near that price to sales ratio. Facebook, Apple, even Amazon, that highly priced company, they only have a price to sales number of about 4 or 4.5, around about that. So, okay, anyway, moving on. If we look at their cost of revenue, that's also growing by a lot as well. Their gross profit is about half of their total revenue. So, their gross profit for 2018 was $913 million. And then we've got a whole lot of other expenses eating into this gross margin. And most of it comes from sales, general, and administrative expenses. Even without the R&D expense, Lyft would still be losing money. So that is definitely something to think about. You know, investors often think that, yeah, they're losing money, but they're putting a lot of money into R&D. But even without the R&D expense, without the research and development, they would still be losing money. Okay, and operating income is negative. Then, and net income on top of that is obviously negative. It's negative $911 million. Okay, so let's think about Lyft as if we are owning the business as a whole. Basically, you pay $20 billion to buy the entire company. And in return, you've got a company that is currently burning through $911 million per year. And it's not looking like this deficit is getting any smaller anytime soon. As you can see, they have been growing the deficit over the past couple of years. So you pay $20 million for a company that is losing $911 million. And this is why Warren Buffett said when he talked about Lyft is that, you know, if you gave him $20 billion, he would find a lot better places to put his money than Lyft stock. A stock that is burning through money, not looking like slowing down anytime soon with regards to getting through that money. And I personally, and yes, I know it's a big surprise, I would have to agree with Buffett. You give me $20 billion, I'm going to find a lot better places to put that money. You give me $70, and I'm not going to be putting it in Lyft stock. They're in an industry that, yes, it is growing, but it is not protected, and companies can easily enter that industry and grab a piece of that market share. And Lyft, they're losing money, and it's not looking like slowing down anytime soon. It's not looking like they're going to become profitable anytime soon. So why would I pay this extremely high price for a company that is losing money and has all these negative connotations to it? That is why I do not want to buy Lyft stock. You know, if I had $20 billion, I would at least want my company to be profitable and have a big moat around it. Something like Berkshire Hathaway, something like that. But, you know, Lyft, they're selling for a price to sales ratio that is extremely high compared to a lot of other tech stocks. Another reason why I think this is a company that is priced too high. And yes, I do know why the stock has been hyped up so much, because it's just been talked about so much on YouTube, on the news. It's just a hyped up IPO. And obviously, a lot of people invest with their emotions. They hear about the Lyft IPO, they don't do the research, they don't look into the numbers, and they just hear the hype and they buy into it. So I do know why this company has such a high price tag to it. Do I agree with this price tag? No, I do not, and that's why I won't buy it. And yes, so yeah, most people do react with their emotions, but am I going to react with my emotions in this case? No, I'm going to react by the facts, and that's why I'm not buying Lyft stock. I'll see you all in the next video. Everyone, let me know what you think of Lyft stock in the comments.